Okay, so this is another one of those Dmitri rants where I talk about stocks, right? Fundamentally, investing into individual companies is a total, complete waste of your time unless you are working in investment research, all right? Because you have to understand, to invest into a single company, you have to do what's called fundamental analysis. And to do fundamental analysis, not only do you have to have a skill to do it, experience to do it, the amount of time to factor in every single like variable that goes into company valuation and future cash flow projection is so vast, you simply will not have the time. In fact, if you're like one person, you probably don't have the time to do it. Now, not only you have to factor in analyzing one company, you have to factor in, you have to analyze thousands of companies per year in order to pick out the one that's actually good. So this is a total waste of your time. Now, the second strategy people adopt, I see, is investing into hype stock. All right. So hype stock is a stock something like in 2020, it was like NIO, Tesla, Plug Power, GameStop, right? Nikola, I think, was another one, right? So people just look at the stock and they say, oh, it went up by like 20% last week. It's going to go up again by 20%. No, this is tulip bulb, all right? This is tulip bulb investing, okay? Because you don't know. Yes, it's true. Next week it could go up by 100%. Nothing stopping it. But the reverse is true. People could realize, wait a minute, I just bought something that I don't know what the hell that is. In fact, there is no value fundamentally in the company. So they're going to start selling, and your stock could end up going to not very good direction. Okay. So let's look at some of the examples of tulip bulbs or the hype stocks, right? Okay. So Carvana. Let's look at Carvana. Hype stock, right? Look, you see? Boom. You see, January 2020 quadrupled. This year, 5 months now, no movement. In fact, it's actually negative. Okay, so that's not bad. That's actually kind of okay. Let's look at this company here, Churchill Capital. 3 years. Look, everybody was buying, 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 and then people realized, wait a minute, what the hell did I just buy? Boom, right? And you have to understand that this stock can become this. Let's even look 5 years. Oh, they went onto the market. So then this company went public, right? And they can even drop lower than this, right? So if you're the guy who bought like somewhere here at 34, you are doomed, right? You are doomed. Why? Because you don't know if the stock is going to go up or not. Oh, that's actually, I have to factor that in. You do not know if the stock will go up after it drops. This is big. This is huge because when you're investing into a good company and their stock goes down in value by like 30%, that's the signal to sell your house and buy that stock because you have done your analysis correct and you want to take it to the next level, right? It's a good buy. Whereas with companies like this, man, if it goes down to €5, I mean, what are you actually buying? That's another one, right? Let's look at Plug. DraftKings was another one, I think, right? Same story, right? Exactly the same story. So from 72 to 42 right now. And again, you have to factor in that they can go lower than €9, $9, right? What else do we have? Digital turbines. Same story, halved. The stock just halved basically. GameStop, I think they're still pumping, but I think they also halved. Yeah, they halved basically. From 350 to 144. Now they still have a very big year to date, but you have to factor in tomorrow this could become €3. It could happen, right? Because GameStop as a company is selling games on streets in shops. How many people in today's society are gonna go outside to buy a game? You have to understand, people buy games in here. That's how people buy. Um, Steam, I think, right? Yeah, you see, you go here, you buy games. That's how you do it. It gets automatically uploaded into your account, which you set up for free, and off you go playing. The idea of having a physical copy or a DVD, it's like it's like looking at it's like looking at Ghostbusters or whatever it's called, Chartbusters. Or do you remember there was a company that went bankrupt because they were renting out DVDs, and then all of a sudden Netflix came out, and then that's it, they went bust, right? That's the same situation. So right now people are investing into Chartbusters, basically. That's what they're doing. Okay, Plug Power is another one, I think, right? Also went down by a lot. Yeah. This is catastrophe. Minus 30% this year. From 62 to 18. Imagine you were the guy who bought like somewhere like in here, right? Something like, let's say, 42, right? 42, it went up to 61. You like, yeah, man, I doubled my money. Holy shit. You wake up and you're like, uh-oh, I now have my money, right? And again, I will stress this hardcore. You do not know if the stock will go up in value. You do not know with companies like this because it was always like $1. Like it could become 89 cents, right? It could become. So what do you do? Do you sell? Do you buy? Right? If you did your fundamental analysis correctly, right? You know that this is a good company. You know it has the future. Right now is the time to buy, right? But because you have not done jack shit and you bought it because it was a hype stock, now you're screwed. You are now sitting at a stock that you bought at 42 that has no future, historically has not performed, and you're probably doomed. I would sell. Like if you're in this position, I would sell. Get out while you can. See the mirror in your eyes. See the truth behind your lie. Okay, we start with Plug Power. Okay, Qualcomm I think is another one. Let's look at them 1 year. Well, they're still okay. Qualcomm is okay. Let's look at QuantumScape. Yeah, QuantumScape Corp is another one. Look, let's say you're the guy who bought it at 75. It doubled. Like this one is a prime example of this, right? And then that's it. It's game over for you, right? Yeah, it's game over for you. A lot of them seems to be IPOs, honestly. Like Quantum Corp is a good example of an IPO, right? Because look, IPO, they pumped the stock, they sold it. The founders probably, most likely, sold it somewhere here, right? They probably sold it at 64, right? And now you're the guy stuck with 64, and the value is 27, and it's probably gonna go down to like, I don't know, $6 or something. Actually, I'll put it into description. Like this is a prime example. Prime example. Well, I mean, Tulip Bulb is a good example where people are just buying Tulip bulbs, but this is like a live company, an IPO, you know. Square, I think Square is okay. I think they're not too bad because you see, like with Square, at least you know it's a company. Do you know what I mean? Like at least you know they're doing something. With companies like Quantum Corp, man, they don't even have a product. Do you know what I mean? Like they have no product. All they have is a bunch of people with presentations telling you, oh my god, this is awesome." And can you imagine, like, dude, this stock reached 132. Like that's crazy. 132, and the company has no product at all, absolutely nothing. Okay, another one. Let's go into electric cars. Oh, that one is a big one. Like this company, I knew they're gonna go bust because I looked at their product. It's disgustingly overpriced electric scooters. Disgustingly overpriced. Now I thought the only way they can compete, they're basically selling Renault Renault Ziggy, I think it's called, right? Yeah, they're basically selling this only in a scooter version, right? And charging ridiculous amounts of money for it. Ridiculous, right? Yeah, you see, they're pretty much selling Ziggy, these guys. Yeah, you see, they're pretty much selling Ziggy, right? Now, what is the advantage of this over Ziggy? There is zero advantage. I thought they were like they said, oh, this is going to be the future of pizza deliveries. If you look at their range, it's disgustingly low. It's too low. Whereas the look, 17, $18,000, right? 120-mile range, right? Ziggy does everything what they do for 10,000. Absolutely everything that they do. And you have to factor in that Ziggy already failed on the market, failed to deliver. And these guys are trying to, and they're like their shares went up by a lot, like to 31. But I looked at the offering, I said, no, this is BS. This is not gonna last, right? And again, you see, now you have to factor in that this could have been 100, this could have been 200, right? But the problem is the future drop. You don't know when it's going to happen, right? And you don't know the how fast, right? Because let's say you bought in here like at 20, now you're doomed. Like there is no way to know. Again, there is no way to know the future of this company. In my opinion, looking at their product, looking at their market, looking at how kind of their technology, and the fact that Ziggy already failed on the market, I don't think this company is gonna last. Right? I don't think it's gonna last. But again, hype stock, people bought it, right? Okie dokes. What else do we have here? Oh, this one's hilarious. This company was selling a truck that cannot be driven. Okay, they went public, and they were selling a truck. It turns out that the truck has no engine, and the videos they made with driving the truck was they were rolling down the truck down the hill. All right. So from 80, that's another one. Like that's not a tulip bulb. NIO is another one. I mean, it was like almost 50 at some point in time, right? Yeah, it was 52. You see, so it's half. Again, I looked at NIO. No cars being manufactured, nothing being sold, yet the stock is just quadrupling. So I'm like, what the hell is going on, people? Right? Workhorse Group. I think they're also in the same boat, right? Oh yeah, 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 yeah. There's. I think I looked at them. Yeah, they're another company. But do you see the dangers of buying the hype stock? Do you see the dangers, right? Here's the stock, you're like, oh my god, it's so cool. You buy at 21, it goes to 34, you double your money, you're happy. You're like, yeah, yeah, and then boom, right, boom. You buy, let's say, again, boom, down. Now, there will be people, I guarantee you, there will be people that will buy today, sell their house, and one of those companies is gonna go up again to like let's say war group it could go up to like 400 for no reason whatsoever, and then you're going to be watching on YouTube on television, and this like 18-year-old kid, and he's like, yeah, I bought war group, and I didn't do jack shit analysis, and I'm just now a billionaire. You know what I mean? Now you have to understand, now there is good results and good decisions. Good results does not mean good decisions. You have to factor in that some people are going to go to a casino and win some money. Is playing casino a good decision? No, it's gambling, right? But he got a positive result. Is buying this company good decision, given no fundamental analysis whatsoever? No, but some people still win. You have to understand that, right? So that's another one. I'll put it in there. The reason why I like we're looking at electric vehicles is because 2020 was the electric vehicle hype year. Everybody was just buying electric vehicles. Yeah, this company is also another one. I looked at it, and like they were saying, oh, this company manufactures a lot of electric vehicles and stuff like that. And I looked at them like what? You know what I mean? Based on my research, I did not see them as a viable competition to current electric vehicle manufacturers. But again, they went public. They the hype, and then boom, and now it's gone. These I think are pump and dump strats. So this company I think is pump and dump. This one is pump and dump, I think, right? I'm pretty sure this company is also pump and dump, right? No, that's not a pump and dump. Because normally they're IPOs, they're pump and dump guys. Oh, Nikola Corp for sure, pump and dump, 100%. Well, no, not really. NIO Inc. I think is a pump and dump as well, right? No, they're okay actually. Okay, so right now, what are the hypes right now? Cryptocurrency, right? The digital art is the hype, and GameStop is still hype, right? I mean, GameStop is still going. I think it's still going, right? Yeah, yeah, it's still going. Okay, so now let's talk about viable strategy. Let's talk about viable strategy. So when you study a lot of investors, kind of like long-term guys who've been in it for like 20, 30, 40 years, who also study other successful investors, traders, they always arrive at the same strategy. The no risk strategy that always works. Now, it's not going to make you into a billionaire overnight. The hype stock will, but it's a gamble. It's like trying to win the lottery, right? You will not get kind of the lottery effect from this strategy in any shape or form, right? In fact, it's actually quite boring. It's a pension strategy when you think about it. You work a high-paying job, right? So we're talking about like a proper job. I'm not talking about you like there in the McDonald's flipping burgers, right? That's not a job, dude. Get out of there, right? I'm talking where you are an accountant, high performance accountant, engineer, doctor, lawyer, programmer, right? Like a trade, something where you can earn infinitely, right? Because doctors can earn almost infinitely, right? If they're good, they can earn infinitely, right? Programmers, accountants, right? Because there is always career progression. Okay, manager maybe. I don't know. You see, I'm not very fond of soft skill jobs because I think there is a lot of friends hiring friends, and because of my personality, I tend to be very critical, analytical, logical. So like if I don't believe in something and if I don't have evidence, I struggle to say it. Does that make sense? Like I cannot tell a person, "Oh, well done," if he like did something and is disgustingly bad. I cannot like it's very hard for me to tell a person, "Oh yeah, 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 well done, you are like superstar." I can do it short term, but long term, it's not for me, right? So that's why I do completely different stuff, right? But again, pick a career where you can progress to high paying job. That's one thing. Second thing, buy index funds regularly, right? You have to invest into index funds, right? Because they have historically performed really, really well. So examples would be like Nasdaq. That's my favorite. That's the one I'm sitting in. Nasdaq 100 or S&P 500. There is also Russell stock. Pick and choose. Basically, find the index fund. Look at the one you like, and look at the returns. If you're happy enough with it, buy it. You can also go into leveraged, right? But make sure they're not reverse leverage because if you're investing into reverse leverage index fund, you're doomed because none of them ever performed. You need to invest into the positive leverage and no more than two or three leverage. Because if you go four, there is an entire article on this. I will actually link it. I think it's leveraged. This one here. I'll put it in the description below, right? So this article pretty much discusses the optimal investing, like the optimal leverage for index funds and if they work or not, right? But bottom line, if you are in S&P or Nasdaq, three is is good. Like 3 is the kind of the tipping point where you can do it. Past that point, it's a bit too too much, and below that is a little bit too low, right? If you are not sure, go into double leverage, right? If you're not sure, because double leverage is like in here, it's overall go-to strategy. But again, I'm in kind of Nasdaq, S&P, so I can go for triple leverage, right? You see, up to 3. I'll link it in the description below. All right. So you're working a high-paying job, you're buying regularly, right? Now, why is it important to buy regularly? Because markets go up and down, up and down. In the long term, they always go up when you look at the index fund. So let's take a typical index fund. Let's look at this one here. That's Nasdaq actually, right? You see, if you look at 10 years, like it always goes up. Do you know what I mean? There will be periods where it's gonna drop significantly, right? There will be periods, but overall, if you hold it for 5 years or more, it will balance itself out, right? Uh-oh. So that was 2000. That was a big dot-com crash. So you see, like if you were buying somewhere in here, right, and then you eventually started buying in here, your portfolio is going to balance it out, right? That's why you need to buy regularly. Does that make sense? Like you just need to buy regularly because you're taking advantage of the market volatility. This strategy here, buying regularly, takes advantage of market volatility. Okay, holding forever, like they recommend 5 years, but like try to hold it for as long as possible, because again, if we look at long term, you see like it just works. If you just do Nasdaq 100 historical chart, I think, right? You see, it will balance itself out eventually. Okie dokes. Okie dokes. So, yeah. And the final concept I want to cover is whether information. No, I'll actually do a separate video on this. This will be why single stock is a waste of your time. And I'll do information does not affect stock. It's gambling.